Writing an angel check is easy. Knowing why is the flex. Angel investing. Underused, misunderstood, explained badly. Angels Decoded, an educated and raw take. In cahoots with Play Money.
Hello and welcome back to Angels Decoded. We're at episode number 7, and today we're looking at convertible notes. I personally don't understand them. I don't know why people use them. They create a whole bunch of pressure when you don't need pressure. Cheryl Kellond, my collaborator, my friend in angel investment here, tell us about convertibles. Why do people still use them?
Good God, I don't know why people still use convertible notes. My goodness. I have more energy about convertible notes than a normal person should. Let me explain what they are. Convertible notes are technically debt that accrues interest and converts to equity at a certain point in the future. They used to be the popular way for startups to raise money in the early sort of angel and friends and family stage before an institutional investor stepped in. And when I say used to be, they used to be the popular way to raise before the Y Combinator safe came along, which at this point has been well over a decade. But they're still in use. We see them most frequently, honestly, in the middle of the country. So not on the coast, but in the middle of the country and with traditional angel groups. And what I hear, what I see in the market is angel investors come in and they make their first few investments and they start to get frustrated with safe notes. They're like, I hear a lot, I don't really know what I own. It's a promise for future equity, but I don't really have anything now. I want more something to hold on to. It's sort of this sort of a trough of angel disillusionment. You start angel investing, then you're like, hey, wait a minute. This safe thing feels a little imaginary. I want something more solid. I think I want to do investments on convertible notes. Or you live in the middle of the country and that feeling about convertible notes has never gone away. And I say that as someone who lives in the middle of the country. So ill-informed.
It's fascinating because a lot of people get attached to something unnecessarily. And we've covered that in previous episodes. We covered it on cap tables and the desire to want to have your name up in lights and why that's a problem. And go back to previous episodes, I believe it's number 4, where we covered cap tables and SPVs. But today, in the sense of convertibles, it feels like it's a legacy thing that happened. And the debt and the interest, for me, my blood pressure goes up when I start hearing debt and interest as a founder, particularly at the start when I'm making probably no money and I'm living off money that I've saved up and life already feels pressure, and having an interest rate on something feels a lot, and there's a time pressure. Can you talk to us about the timeline on a convertible and how that's set up? Like, how long does that last? And then what's the workflow from a founder perspective?
Yep. So all 3 things you mentioned. So convertible notes it's debt, technically. It has an interest rate and it has a time clock on it that after a certain amount of time, it automatically converts to equity. But here's the reality of those 3 things. If you feel like you are holding on and owning something because you have debt in a pre-revenue startup with 3 people running experiments, like I got a secret for you. You shouldn't be investing in startups. That debt's you're never there's no liquidation stack that's going to happen that's ever paying you out the debt. You took a bet on a team building something brave and new. Own the bet. So the debt's not paying off to you. I hear people get sort of excited about the interest. Like, why? Because you think your money is sitting somewhere not doing anything for you? You invested in a company and that team that you believed in is working their damn butts off. Like, that money is creating value. The interest part is actually particularly funny because if that convertible note converts to equity, the interest you're earning converts to a little more equity around with it. And when that happens, woohoo, yay, good. You invested $10,000 and maybe you held it for a year at a 10% interest rate. You get $1,000 more of equity. You also have to take that $1,000 and pay your tax accountant to report it on your taxes as phantom income. And then you have to pay taxes on that phantom income. So like, what are you going to pay taxes? Like 40% on that phantom income. So there goes $400 out the door. Plus you're probably going to pay your tax accountant $300 just to figure out this phantom income thing. So I'm going to say that interest is not all it's cracked up to be. And then the third thing is, and this is on paper, it looks like another benefit over safe notes, that it has an automatic conversion time frame on it. After 2 years, it automatically converts to equity. If you have ever invested in a company on a convertible note, you know what happens when it comes up to that time frame? If they haven't raised a price round yet, they just extend it. They're like, here, vote to extend it. And you all say yes. It's just what happens. And you actually secretly sort of want to say yes because, when we talked last week, Andy, about safes and the way they're non-dilutive until they convert to equity, convertible notes are the same. So you actually want to hold on to your non-dilution because even if the founder is using a convertible note, they're probably using them to raise money over time in a less coordinated way, which is exactly what an early stage company needs to be doing. So all the things you thought were bright and shiny about a convertible note, sort of an illusion. And they've got a big downside too.
Really good call outs. And thinking as far as what that flow on effect is, and you covered phantom income, I think we probably should do a whole episode on phantom income because
I don't know about that. I mean, there's not much more you can say.
well,
Sort of got you there.
Well, I would say anyone listening, watching, just read up on what phantom income is because it can bite you.
Go out and touch grass instead. It's really not that interesting.
But the other part I want to build out there a little bit on as far as the relationship that you have. So as an angel investor, you want that founder to shine, to grow, and be the best version of themselves. And for me, just the nature of the agreement of a convertible puts pressure into a relationship that doesn't need to have pressure and intensity around it. And even from a resentment perspective too. And if you raised $1 million on a convertible, and then say it was at 10% and you gave away an extra $100,000 using simple math as equity away from your company, as a founder, like you'd look at that and go like, why am I even doing that?
You're pissed. Let's be really clear. You're working your butt off. You're sort of pissed.
Yeah. It's interesting because for me, and we're not covering a price round today, but the convertible lives right in the middle of a safe note and a price round as far as the way that it functions, the risk. It's a medium level of everything in the sense of,
which means it's a nothing burger.
Yeah, totally. It's like for me, I would rather do a price round than a convertible because at least then you've got some semblance of structure with what you're doing. But you could only do that, which we covered in our last episode, is if you don't need money in the bank immediately. If you're trying to get a large sum of money and you can wait a year for that, is why you would use a price round. But again, I would love to have someone sit here and convince me of why a convertible is better than a safe note.
Well, first of all, it's not going to be me that convinces you of that. Price round has its own issues. There are costs involved with it, and you really do need someone to lead and set a valuation. And we can dig into the weeds of that in another episode because I will have more spicy takes on that because I'm actually starting to go out and I would like to raise my next round for play money on a priced round. And I think it'll be an interesting discussion when I go to do it. But here's the other thing. There's 2 other things about convertible notes on this track we're talking about. All the things you believe about them are actually phantom like those income. We went through that. The other thing most people don't think about is QSBS, qualified small business stock. And one of my favorite topics to talk about. It's essentially if you invest early in a startup and have equity, if you hold that equity for long enough, when you get an exit and returns from that startup, you don't have to pay capital gains tax on it. When you invest early stage in a safe note, it's a little bit, so you can probably claim that safe is QSBS qualified. It's written into the Y Combinator safe note. There's no case law. No one has dropped a decision down on large about this, but we know people do it all the time. They had a safe note. They start their time clock ticking. It's a 5-year hold period in the simplest terms. If you hold it for 5 years, the company exits, you make money back, you don't pay capital gains. If you sign a convertible note, There is no gray zone. That is debt. There is no QSBS. So you're in a position where, okay, so you've paid your tax accountant for the phantom income. You've paid 40% taxes on the phantom income from the interest on the note. And then you've lost 2 years or 3 years of the clock ticking on QSBS, which is what, a 20% tax benefit? So no QSBS is one of the downsides. But the other is, and this is actually the reason I get all fired up about convertible notes, and I realize I'm a little spicy about a document right now, and I shouldn't be. Convertible notes are a royal pain in the butt and really expensive. Because here's what happens. You can raise on a convertible note. You want it to work a little bit like a safe, which means you're closing different investors at different different points in time. So every one of those investors has a different start date on that accumulating interest on the note. Let's say you sign 10 or 20 of these, all with different dates, and then you go to raise the price round. Do you know what a rat's nest you're handing to your lawyers to have to model out in spreadsheets to figure out actual equity ownership at conversions and customize all that paperwork and double check the math? And I did my first company before, God, I'm old, before the safe notes came out. I did my second company on half safes, half convertibles, because we were right around that cutover period. It cost me so much money in legal fees, so much money in spreadsheet checking. Like, you as a angel group or founder asking a company to take a convertible note, or actually putting a big administrative cost burden on them that you don't even realize you're doing. And it's just not where your founder needs to be focusing their time. So that's maybe why I get a little hot about it. You're not getting yourself any advantage as an investor. You're actually getting yourself disadvantage, and you're just giving one more obstacle and roadblock to your founder at a time that they need as few as possible.
I like it. And just the practicality of like doing a prorated version of day that you invested to day that equity closes.
Like,
and
to the day.
Yeah. Like, well, you had 732 days. This person had 224, and then calculating the cap table and then getting the legalities around that for no real upside, because again, you lose the capital gains tax benefit, which as an early stage investor, that is a significant amount of money. If your business goes on and exits and you're early stage investing, like, that multiplier is significant. So that tax difference is a lot of money. So for me, I'm in your camp. But if you're to wrap up, I think it's worthwhile doing. Let's just be diplomatic and be nice to someone who may think that a convertible is a good idea. If you're an investor and you've got a company that you love, even if it's a friend, say you're an uncle, you've got an uncle who wants to invest in you and you're doing a convertible, like, what are the couple of things that you should look at as far as understanding that, as far as like valuation, terms, what that, like, give us the 101 on how you should approach that conversation?
The reason I'm giggling is because I had an uncle that invested on a convertible note once, and I heard about it every year at Thanksgiving.
I might have
for
known
years,
that story.
For decades.
I might have known that story, and it might have been a loaded question.
I was like, ooh, poke me where it hurts, man.
Thanksgiving with Cheryl and convertible notes.
For a decade. For a decade. So, I mean, from a value, convertible notes will work similarly to safes with a post-money valuation cap on it, and it converts the same way. The lesser of the valuation cap versus what the priced round is. Sometimes it's got a discount built in. I don't want to try to do discount math and explain that on a podcast. But the numbers you'll see on a convertible note are similar to what you'll see on a safe. When I've seen founders use them, it's often because they raised from an angel group that insisted upon it. because the Angel Group doesn't do safes. I don't know if I've met a founder that has willingly, in the day and age of the Y Combinator safe, say, oh no, please, I really want to do a convertible note. That'll be a great idea, because of the overhead and the hassle. And yeah, I mean, I think you said it best, Andy, that little like nattering feeling of the longer you wait to do a priced round, the more dilution you're taking just because it's taking you longer to do a priced round. Like, stop and think about that for a second. In the world where it's cheaper and faster to build, is the goal a priced round? I don't know all the time.
Yeah. In 2026, that is a big question, and one we're not going to solve in this episode today. But
I got thoughts on when it's time.
I know. I feel like that I know all the handle to turn in the Jack in the Box of Cheryl Kellond.
You know my buttons.
Well, convertibles still exist. Personally, I'm not in favor of them. I would choose a safe note any day. And if your ego is getting in the way where you feel like you have to have equity today, convertible doesn't actually solve that either. So it's good to be aware. This has been a fascinating take. I love recording these. It's good for me, and I think it's important for everyone to understand as well, is that there's a lot of folklore and a lot of things that get pushed around. But understanding this is important, which is why we've started Angels Decoded. Cheryl, thanks for joining me. This is episode number 7. We'll see you next week.
Bye now.
Angels Decoded, a weekly podcast for people learning the craft. Angel investing made easy. Subscribe, then decide. Angels Decoded, in cahoots with Play Money.